All right, as a private money lender, who is our client and what process or what service do we provide to them? And how does the numbers of our client break out so that we know that we are doing a good job and providing a good service? My name is Rich Lennon. We talk growing the money every morning here on this podcast from 9 to 9:10. And thanks for joining us. And we're just going to dive right in. So, as private money lenders, we have one specific client. That client is a real estate investor. Now, that real estate investor could do a bunch of different things, but in general, that is who our client is. And the reason that the market exists for us is because big institutions do not do this type of lending. If you want to buy a home and you want to force appreciation, and what I mean by forced depreciation or appreciation is you often have them repair the house. Something's wrong with the house. There's some situation where it's fallen into disrepair and you come in, you're going to do the work. You're basically going to act as a general contractor. You're going to put a little time, a little effort, and ultimately you will get compensated for that sweat equity that you put into the home. But a bank won't do that loan for you. Oftentimes our clients, they need the money sometimes that same week, 3, 4, 5 days, definitely within 2 weeks. It's very rare that I get someone who wants to borrow money longer than a 2-week span. And institutional money just won't do this type of loan. So it's really left to the private sector, you and I, to be able to make these types of loans to help these types of business grow. So what we're going to do is we're going to talk today about who that client is, and I'm going to go over the numbers that client makes. I want you to understand the returns via percentage, and we'll use an example, but how much does the flipper make when they are flipping a house? And we're just going to run down those numbers because we've got to make sure that we are providing the right service to our client. And that's how you get longevity in the business. You have to make sure that you are adding value and that everybody is winning. And then it's a truly win-win-win. And if you do that, then the money comes and you can have a business that lasts a long time. All right, so we're going to break it down. I'm going to break down the flipper. I'm going to break down the flipper as the person who buys a house, does some construction work on that house, forces appreciation. That's what we call that in the business. When you do that construction, you force the depreciation through your sweat equity. You go out, you swing a hammer, or you hire a general contractor to swing that hammer. And what once was a rundown home is now a beautiful home ready for a family to move in. And so in Richmond, the most common flip that I use the example of all the time is when that retail value of the home is about $300,000. So we're going to use that as an example. All right, this is the way it works. The flipper throughout time, and I think almost in every community in the United States, and I'm sure there are exceptions that someone will point out, but it's generally considered that they want to purchase the home at a 70% loan to ARV, as in once you buy the home and you put the repairs into the home, that you are into the home for 70% of what you can sell it. So if the home can be sold for $300,000, by the time you purchase the home and you do the renovation on the home, the maximum that you should be into the home is about $210,000. And we're going to break down the numbers of what that means. And so the margin in this case is 30%, and that's the standard margin for our client. So on paper, they look like they're going to earn $90,000, but of course we know that's not true. And so we're going to break down where their expenses go. So the first expense that they have is the money expense. That is you. So you're going to lend the money to them, and then they're going to give it back. Now, based on the fact that you're going to only lend them the money for about 6 months approximately, and that you are only lending on the amount that they borrow, not the eventual retail value of the home, it's around 6 to 7% that the flipper pays for their money costs. So out of the 30% profit, 6 or 7% of that goes towards money. Around 10% of that goes to the eventual closing on the property. And it's the 10%, by the way, of the $300,000 of the retail price, not the amount of money that was borrowed. So in our scenario, if the flipper sells the property, they're going to pay approximately 10% or $30,000 to complete the sale of the property. 3% goes to the selling agent, 3% goes to the buying agent. Generally, 1% is considered your own closing costs, and typically at the $300,000 price point, you're going to give 3% in closing costs to the buyer. So it costs around 10%. And then the other percentage that is in there is the carrying cost of the property. You have to pay for the water that runs through the lines. You have to pay for the electricity that runs through the lines. You have to pay the insurance on the property, things like that that are considered the carrying cost of the property. So it breaks down that a good flipper that is good at their business runs somewhere between a 10 and 15% margin on the property. So a $300,000 retail flip, they should be earning somewhere between $30,000 to $45,000 for that project. And that is what is in their mind when they're making their offer. And so in the way the money breaks down in that, I wrote it down for us in that scenario that we're talking about. So if they borrow $200,000 on this flip for you, their money costs are approximately $20,000, 10% for 6 months because you're charging around 20%. $30,000 are the closing costs. And it's worth pointing out that a lot of the risk that is being done in this transaction is being done by the flipper and the money lender, but the person who takes the largest percentage of the deal are the people who close the deal, those real estate agents, and the closing itself, they earn quite a bit more. The holding costs on this deal would be around $6,000. So we have $20,000 for the money, $30,000 for the closing, $6,000 for your holding costs. And so in this scenario, the flipper would approximately make $44,000. So you got a fair amount of money when you lent out the borrower. The flipper took a tremendous amount of risk, put a tremendous amount of sweat equity into the property, and then earned somewhere between $40,000 and $45,000 on the property. Is this a win for everybody? I would make the argument that it is a win for everybody. It's a win for the person who is lending the money. It's a win for the real estate agents as they get their cash flow, we run that real estate engine. We push money through to the attorneys. We push money through to the insurance companies. We push money, of course, through to the agencies. Right. And then the last one is, so do we, not the last one, have we created a true win-win? And I would say the answer is yes, especially because you can't get this institutional money. The next one that we want to talk about very briefly, because I'm already out of time, is our other client. The other real estate investor is the person doing the BRRRR. And we give a person the opportunity to make infinite returns by being a private money lender in these situations. So on the BRRRR, which is buy, renovate, rent, refinance, and repeat. And you can try, the intent of this strategy is to get rentals into your portfolio, hopefully with no money down. So if you can get a formula on the BRRRR for these real estate investors where after the repairs and all their expenses, they are in approximately 75% to the appraised value of the home, and they have a 1.25 ratio on their monthly rent, as in if you lend them $100,000, they have to make $1,250 of rent per month. If they can find that formula, they can basically buy all the houses they want for free. And that is the BRRRR method. And so our two clients were both adding a tremendous amount of value. The flipper is getting eat money. They're getting the money to run their business, to feed their families, to put food on the table, to pay their own mortgage. And the BRRRR clients, still real estate investors, are people we're allowing to make infinite wealth. And so do we offer a very good service? We do, especially because they really can't get it anywhere else. All right, that's it. That's our client. I felt it was appropriate that everybody at least look at the perspective of, is our money lending service providing value to our clients and our community? And I think the answer to that is a resounding yes. My name is Rich Lennon. If you'd like to find out more about private money lending, hit me up, richlennon.com. If you want to see exactly how I lend so that I fractionalize my notes so I earn between 30 and 50% returns on these types of loans, download the Smarter Wealth Blueprint. And if you're still interested, hit that growth call. I'm happy to get on a conversation with you and we can talk about it. And maybe I can work with you and you can work with me and we could build your private money lending business. All right, everybody have a great day.